Okay. So, accounting for corporation. Remember how we just talked about in chapter 12 the partnerships, right? So now we're going to look at how corporations are formed, what corporations are, what are their characteristics. Remember how a partnership was an entity that was started by how many people? Huh? Two or more, right? And then a corporation can be one owner, or it can be several owners, right? Um, Here are some of the things or characteristics um, of a corporation. It could be privately held, meaning the owner has not extended an offer to purchase stock within the corp, or it could be publicly held, meaning that they trade on the public stock exchange, and therefore they do have corporate stockholders or shareholders, whichever name you want to use. So it is a legal entity. It is separate from its owners, meaning just because someone owns the corporation, it does not mean that they are personally liable, okay, for anything that happens. And of course, as far as profit is concerned, that's not personal. That would be for the corporation. And then there are some different rights and privileges that go along with that as well. So let's look at some of the advantages and disadvantages. First advantage, separate legal entity. In other words, it's separate from the person who actually owns it, right? So that means that legally, if anything is tied to that corporation, it's the responsibility of that corporation to answer any kind of legal action. It is not the responsibility of the owner personally to answer anything. Secondly, limited liability of stockholders, meaning you can be a stockholder in a corporation, but you are not liable, right, personally as a stockholder for anything that happens within the corporation. You purchase stock within the corporation so that you can have the right to do things like vote and make decisions within the corporation, but not personally liable. Transferable ownership rights. So what that means is once you start purchasing stock, you can transfer it as you please. You can sell it as you please within that corporation because you purchased it. Continuous life. A corporation never dies. You know how with a partnership, we said a partnership ends based on what? Death. Or
someone wants out.
Someone wants out, bankruptcy, right? But with the corporation, that's different because it is not tied to those who actually started the corporation, who actually own it, and it's not a personal type of entity. There's continuous life. So the person who owned the corporation could easily pass off that ownership to someone else, or they could share that ownership with someone else. And if anybody dies, the corporation will continue to function well after they die. Lack of mutual agency for stockholders. What does that mean? First of all, if we're talking about a corporation, we're talking about stockholders who have purchased stock within the business, right? Stockholders do not have the right to go into contracts for the corporation just because they own stock. Does that make sense? Meaning, yeah, you own stock and your rights or privileges are to be able to vote on certain things within the corporation, but you have no right to actually bind in any kind of contractual items on behalf of the corporation. You don't speak in that aspect for the corporation. And it just means that those who own it, they make those kind of decisions. So you can't enter into contracts just as a stockholder. Ease of capital accumulation. How do you think they raise capital in a corporation? What's the whole purpose of a corporation? It's ran by who?
Shareholders.
Stockholders or shareholders. So that means the way that they're going to accumulate capital is going to be by what? Trading, selling, buying stock. That's how they accumulate capital. Okay, disadvantages. Governmental regulation. If you are an owner of a corporation, you are regulated by the government in several different ways. Okay, first being if you are publicly held, meaning that you're trading stock on the U.S. stock exchange, there are certain rules that go along with that. Secondly, accounting related, we know that we are governed by regulations of GAAP, right? And Sarbanes-Oxley. And when you become a public corporation, meaning that you're trading and selling stock on the public stock exchange, then that means that you have to go according to what's in the Sarbanes-Oxley Act of 2002. You remember that from Financial Accounting 1, right? Where that protects investors, it protects stockholders who purchase stock within the company, and it just holds corporations accountable for accurate and timely financial reporting, okay? And making sure that it is free of error. So that's another government regulation. Corporate taxation, which is another disadvantage because corporations are taxed on two different levels. What do you think they are? And it says it in your book as well. Think about it, in a partnership, the only taxes that were paid were personal income taxes on the partner's income from the business, right? Their personal share of that income. For a corporation, they're going to pay state income taxes, right? They're going to pay federal income tax, and what else are they going to pay?
Food and ticket,
No.
dividend.
If they have employees, yes, but they also pay. No, not salary. Don't think that way. We're talking about their responsibility to the government, local government, and
What's that, unemployment?
not on a payroll aspect. They are required to pay federal and state income taxes, right? That could be all the way up to about 40%. So if you're thinking 40%, they're also distributing what to stockholders? Dividends, right? And so they're going to pay money on the cash that they've distributed out to stockholders as well. The stockholders are obviously going to pay on it on their personal tax return. But it's like what we like to call double taxation, meaning not only are they responsible for state and federal income taxes, but they're also responsible for paying taxes on any cash dividends or stock dividends paid out. Understood?
Yes.
Okay, so this is the pyramid. It shows you who's on top and who's at the bottom. The reason why we have this in place is about corporate governance and the things that corporations are expected to do, the things that they're expected to uphold within their corporation environment. So it starts off with the stockholders, right? And the stockholders, you remember those rights that I told you to vote? Who do you think they vote in? Board of directors. Stockholders vote in who they want to be on the board, and the board in turn elects who they want to be those executive officers: president, vice president, CEO, CFO, COO, those types of things. And then, of course, once those people are in place, they are responsible for gathering the employees, the lower level employees. So just keep that in mind as to how the direction goes, because notice you don't see owner anywhere in there, right? But who's to say that the owner of the corporation is also not one of these elected executives, such as president, vice president, or any other officer for that matter? Okay, so organization chart. This just shows you what kind of power each person or each group of people may have. So ultimate control goes to stockholders, right? Because they are the ones that really actually run that corporation. They purchase stock for a reason so that they can have voting rights and other privileges. And they generally meet once a year to hash out a lot of other things like electing board of directors, electing higher officials. Board of directors, they are selected by a vote from who? Stockholders. Overall, they are the people that are responsible for managing the company, making sure that people like vice president, president, and all that are elected, making sure employees are in place, and also making sure that operations and everything flows smoothly. And then the president and all the people under that person, ultimately, their responsibility is to do whatever the board of directors wants them to do. So here's some rights for stockholders. They can vote at the meetings, which is very important. And we're going to get into what type of stock you need to have in order to actually be able to vote, because every stockholder does not have the right to vote. There are classes of stock. They get to sell their stock if they want to. They can purchase some more stock if they need to. They are entitled to dividends, and that also is going to be broken down by class, depending on the class of stock that they have. And share equally in any assets remaining after creditors are paid in the event of liquidation. So if a corporation is completely shut down and they have to sell all the assets and liquidate the business, then of course, stockholders are set to receive cash from whatever has been liquidated after all debts have been paid. So this is what a stock certificate looks like. This shows the stockholder shows that they actually own the stock and how much of the stock they own with the company in which they own the stock for, which is very important. So notice down here this note. When the stock is sold, the stockholder signs a transfer endorsement, making sure that this certificate will be transferred over into whoever the new owner's name is. So, basics of capital stock. Total amount of stock that a corporation charter authorizes. And I know in your book it mentions on page 512 about the charter. Now, what is the actual charter? They didn't show it on the PowerPoint, but we still need to talk about it. The charter is put in place for a corporation, and that charter is going to state how much the company is authorized to sell as far as stock shares. Okay? What price they are able to sell it at. Whether or not it's going to be of a certain value, meaning par value or no par. We'll get into that later. One right for stockholders that was not mentioned was the preemptive right. What do you think preemptive means? It's based off of the percent of shares that you have. So let's just say you have 50% of shares. If you have 50% of shares, then what that means is when it's time to purchase more shares, additional stock, you have the right to purchase up to how much? Up to 50% when additional shares are available to be sold or to be purchased. Now, capital stock, going back to this. Authorized stock. So that authorized, hello. The authorized stock is what's in the charter. Okay, that's going to tell you what the corporation can actually sell as far as shares are concerned. So notice here in red you have authorized, right? We know that's on the charter. And then down here you have issued. That means that's the amount of stock that has been sold out of those authorized shares. And the remaining that's left, what do we call that? Outstanding. Outstanding. So make sure you understand authorized stock is the amount of shares that have been authorized where? In the charter, in that corporation's charter. And then the amount issued means that the amount of shares that have been what? Sold. And the amount of shares remaining would be considered what? Outstanding. Okay. This is where I was talking about the different classes of stock. You got par value, no par, and stated value, and all of them mean something different, okay? Par value is the amount that the stock sells for that's in the charter. Like if they say there are 50,000 shares to be authorized, and that's on the charter to be sold at some point, and they say it's at $5 per share, $5 par value, that's because that's the value or that's the price of the shares within the charter, okay? No par, what do you think no par means? Does it have a value?
It could be defined.
Yeah, it can be issued at any price. Meaning in the charter, it says no par, meaning it's up to the corporation to decide what the value is going to be per share. Market price is the amount that each share of stock will sell for in the market. So just because a charter may say that the par value is $5, if on the market it's selling for $2, if you are a stockholder and you plan to sell your share, you can only sell it for what price?
$2.
That's the minimum that you can sell it for. Okay? That's the beauty of market price. If you sell it for higher than that, that's your business. But just know on the market, other shares will probably be the $2, which means that more than likely your shares won't be purchased right away, right? Because there are some out there that are $2, obviously, if you're going to sell it for more than that. So issuing par value stock, and we have not yet, we're just assuming with capital stock that we're dealing with common stock only. We'll talk about it later. But par value stock, on September 1st, they issued 100,000 shares of $2 par value stock for $25 per share. So what's happening is clearly they're making a gain, right? If the price of the stock was only $2 and they're selling it for $25, that means that they're getting at least 23 extra dollars per share that they sell. Down here, common stock at $2 par value for those 100,000 shares is 200,000. Obviously, they made how much? 2,300,000. No, they didn't make 2,300,000. What did they make off of it? 2,000,000 what? 500,000 is what they got. 2,500,000, but the stock was only worth 200,000, and they got an excess or a gain of $2,300,000. Now, looking at this, this just shows you how all of this ties into stockholders' equity on your balance sheet. We're showing that we issued out of our 500,000 shares that we authorized, we only issued 100,000, which means how many do we have outstanding? 400,000. And they were worth 200,000 and paid in capital in excess of par, 2,300,000. Retained earnings. What do you think this amount is for?
The 400.
Retained earnings balance is 650,000. What do you think retained earnings is for?
The dividend.
Dividends that have to be paid out. That's why a company has retained earnings. They put money towards retained earnings so that they can determine at the end of the period whether or not they're going to be able to pay out cash dividend to stockholders. And then, of course, total stockholders' equity, $3,150,000. So issuing stock for non-cash assets, it does happen. Sometimes a stockholder will say they would rather do what? Issuing stock for non-cash assets. I would rather give you an asset for stock instead of paying cash. I may have more land than I do cash. So I want to donate, I want to, sell that land to you for some shares of your stock. This is that type of example. They issued, They issued 100,000 shares out of their 500,000, right? At $2 par value for stock, for land valued at $2,500,000. So they're showing where they're getting this land, $2,500,000, giving up $200,000 in capital stock, and then also putting paid in capital in excess of par of $2,300,000. So let's talk a little bit about dividends. And then I'm going to go back. Well, before we do that, let's just go back. Because we talked about par value. We talked about no par. We did not talk about stated value. What do you think stated value is? If par means that it was the price that was issued on the charter, and no par means we can tack any price on, what does stated value mean?
It's I'm trying to put it in my pocket. This was stated by the directors.
By the board of directors? Does everybody agree? everybody should agree because it's in your book. Stated value is simply no par. It's still no par stock because it has no value. Okay. The value that is placed on it is placed on it by the board of directors, and the board of directors may either try to match whatever is on the market. They may go higher. They may go lower. But either way, that's the liberty of stated value stock. Is it can only be determined by the board of directors. Okay. Not by stockholders, but by the board of directors. And if you want that stated value stock, then that's the price that you will have to pay. Now let's talk a little bit, because the PowerPoint does not do that. Let's talk a little bit about class, okay, stock class. We've been going on and on about common stock, but there are different kinds of stockholders. You have common stockholders and you have preferred stockholders, okay? Common stockholders generally pay a lower price for shares, which in turn allows them to buy probably more shares, right? Preferred stockholders pay a much higher price for shares. And the reason for them paying a much higher price is because they get more privileges or benefits than common stockholders do. First benefit that they get is they always have first dibs on dividends paid out, whether it be a stock dividend or a cash dividend. Okay? So because preferred stockholders have first dibs, that means if, let's just say, a corporation decides to pay out $10,000 in dividends this year. If you owe $12,000 to preferred stockholders in dividends, and you only have $10,000 to pay out, you're in arrears how much? $2,000. That means that common stockholders will not get anything for that year because it all went to the preferred. It's the reason why it means preferred, meaning that they get the money first. Okay, they paid a higher price. That's the privilege they get. The second privilege they get are the voting rights. That's not a privilege for them. Why do you think preferred stockholders who pay a higher price do not get to vote?
Because they already own part of it.
They own a significant amount of shares. That is one. And think about it. Common stockholders have to have some kind of privilege, right? They don't get first dibs on dividends. They do pay a lower price. That's an advantage, right? For stock. But they also get the right to vote on the board of directors. And the reason for that is because they own a significant share of stock as well, because them paying a lower price allows them to buy way more. So they get the majority of the vote. So just now that you know the difference, preferred stockholders pay higher price per share, get first dibs on dividends. Common stockholders pay a lower price per share, but they get ultimate voting rights. Everybody understands, right? Okay, now we can go on to dividends because it makes more sense now that you know the difference of the stockholders. So the way it works is that corporations determine or declare that they want to pay dividends for the year, and that's coming out of retained earnings. They decide to pay the dividends, and then it goes as a dividend to the stockholders. It says here, to pay a cash dividend, the corporation must have what?
Significant balance and retained earnings.
Right, so that retained earnings balance can't be negative, because if it's negative, that means that they can't pay out dividends. That's one. Two, they have to have the cash necessary to pay the dividend. So what happens if you only have $5,000 in dividends in retained earnings? You may not want to pay out $5,000 because it's going to leave you with zero in retained earnings, right? But you cannot pay over what is in that account. So these are the three important things about, and you need to remember it because every time you do journal entries when it comes to dividends, you got to know what needs to be recorded and what does not. There are three important dates. Date of declaration, meaning where they're actually acknowledging that the dividend has to be paid. It has become a liability and it has been placed on the books as a liability to be paid. And then date of record. There's no journal entry required for that. That's you determining what date you plan on paying the dividends. And then date of payment, actual payment, recording the payment of that cash dividend to the stockholder. So this is an example. They have $1 per share cash dividend, right, that they've declared, meaning they've determined that they're going to pay a dividend. And 10,000 common shares outstanding. The dividend is going to be paid on March 19th. That's the what date is March 19th? What's the declaration date? January 19th is the declaration date. Good morning. What is the date of record?
February.
Date of record? February 19th. What's the date of payment? March 19th. So we know for data declaration, there is a journal entry for that, and we're showing where we're putting the liability on the books, right? Showing that it's going to come out of retained earnings for $10,000 and that dividend payable $10,000. Now this is the date of record, right? Meaning we decided that we knew we were going to make the payment. We knew this as of February 19th. And down here is the date of payment because we knew on March 19th we would pay that dividend. So we took it out of our common dividends payable account and also decreased our cash by that $10,000 to pay out cash dividends. Now sometimes when we talk about deficit, we're talking about in arrears, okay? Sometimes a company will go without paying dividends for so long to where they'll have so much in arrears and then they decide to pay it all at once, sometimes when they get a boatload of money. So it says the deficit is created when a company incurs cumulative losses or pays dividends greater than the total profit earned in other years. So what we have here, common stock, those same 10,000 shares worth 100,000. The deficit was already 8,500. So now that decreases the equity account down to 91,500. Which brings it down to zero, ultimately, retained earnings down to zero. Stock dividends, sometimes they don't always pay out cash dividends. Sometimes they pay out stock dividends. And in that case, when they do, that's fine for them to do it that way. They say a distribution of a corporation's own shares to its stockholders without receiving any payment in return. So it says they can be used to keep the market price affordable, because obviously if they're distributing stock dividends, then it's going to be at whatever price is on the market. And then secondly, they can provide evidence to management that the company is doing well. Obviously, if a stockholder decides to take a stock dividend versus a cash dividend, that's a good thing for a company, because that means that they want more stock in the business because clearly it's doing good, right? Versus cash. Small stock dividend, distribution of how much?
25%.
Small stock, small. Less than or equal to 25% of previously outstanding shares. Large stock would be greater than 25% of previously outstanding shares. So here's a small stock dividend. They have those 100,000 shares at $1 per share. So they have declared a 2% stock dividend, and they're selling that for what? $10 per share, right? So here they show you the computations. You got those 100,000 shares times the 2% stock dividend. That's less than 25%, right? Which makes it a small stock dividend. That equals 2,000 times the price per share of $10 gives us 20,000 coming out of retained earnings for the stock dividend. And the 2,000 comes from here. This is what the stock was actually worth. And then they made a gain or paid in capital in excess of par, 18,000. That's just what a small stock dividend. So this is just showing you the stockholder section of a balance sheet, what it looks like prior to that stock dividend and then after the stock dividend. So prior to, notice they had the 100,000 shares at what price? $1, right? And then issued an outstanding 100,000, paid in capital in excess of par was 8,000 already. Total paid in capital 108,000. And then retained earnings, they had a balance of 35,000. Now look down here, they've distributed 2,000 of those shares. So now the shares issued goes from 100,000 to 102,000. Paid in capital, of course, is 26,000, and then total paid in capital, when you add those two, gives you 128,000. The new retained earnings amount after that distribution was 15,000. So the stockholders' equity amount is still 143,000. So a larger stock dividend, which means greater than what? 25%. So you can see it's 40% on this one. 50,000 shares were issued, and they declared a 40% stock dividend, selling at $8 per share. So the 50,000 that were outstanding times the 40% dividend gives us 20,000 shares to distribute, times $1, 20,000, and that's how they're showing that in this journal entry, being deducted from retained earnings and paid out as a dividend. So stock splits. What does that sound like to you? What do you think a stock split is? It's on page 520. I talked about it before. If you own 50% shares within the company, when it comes time to distribute more or additional shares, you're going to be able to purchase up to what percent? 50%, right? Because that's what you started with. So this is what the stock split refers to. It's going to be distributed based on the percent of ownership within the company. Old shares, they're showing here of 100 shares, and then new shares are how many? 200 shares. Remember, the first 100 shares that were purchased were at $10 per share. For them to do a stock split, now they're at what? $5 per share, and then double the amount of shares, obviously, because it's cheaper than initially what it was. So here they're just talking about what I already talked about as far as the classes of stock with common stock and preferred stock, and they're just saying here with preferred, they have priority over common stockholders to receive dividends first, right? And in case of the corporation closing and liquidating, then of course they get proceeds from that first, after debts have been paid, of course, before common stockholders. Down here in this little graph, they're showing you corporations with no preferred stock, and then corporations with preferred stock. So this just means this 73% represents companies or corporations that literally only have one class of stock, meaning common stock holders. And then the blue part are the corporations that have both common and preferred.
Which are most likely the larger corporations, right?
Not really. More than likely, my take on it, the companies that are in this little green section are probably smaller publicly traded corporations, because it's probably all they can afford is to have common stock.
Yeah.
The blue part are probably the larger ones
Yeah.
that can afford to double the price of their shares and sell it to preferred stockholders, and common. They can distribute the pie a little better. So cumulative and non-cumulative preferred stock. What does it mean to have cumulative preferred stock?
Must be paid for dividends.
What's in the red though? Dividends and arrears. What this means is this set of preferred stockholders who have not received dividends in quite a while, quite a couple periods. So they have some in arrears, and they also have current ones that have to be paid. So what it's saying is, if you are a cumulative preferred stockholder, when it's time to pay dividends, they have to pay you what you have in arrears first before you can get anything current. If they pay it all in one, that's great. That's a great situation. If you're a non-cumulative preferred stockholder, what does that mean? In other words, you can get the current, but they are not obligated to necessarily pay you what's in arrears. So I'm pretty sure that they pay a different price, obviously. But just so you know, the different types, cumulative versus non-cumulative. So down here at the bottom, they're showing you the equity section of the balance sheet and showing you common stockholders paid $5 par value per share, right? They've been authorized to issue 40,000 shares for common stock. Preferred stockholders get 9%, 100 par value per share. They've only been authorized how many shares? 1,000 as opposed to 40,000, right? At $100 per share, you're not issuing that many shares because not many people are going to want to buy it. And then it's showing the paid-in capital for both. And the numbers, I don't want you to be thrown off by the fact that, oh, common stock was issued, 200,000 was made, preferred stock was issued, only 100,000 was made, because I guarantee you, for that 200,000, it could be everywhere about 5,000 shareholders, as opposed to maybe 10 to 20 preferred stockholders. So, if preferred is a stock is non-cumulative, what does that mean?
Is, you get paid arrears.
They don't get paid the current. They don't get paid.
Do we need to go back?
No,
Pay dividends.
We
They're not-
get-
Cumulative means they get the in arrears first.
Yeah, that's what.
Non-cumulative means whatever's in arrears is not a factor. You only get the current, right?
Yes.
So non-cumulative, 2012, they didn't get any dividends, so that's technically in arrears, right?
Yes.
2013, preferred dividend was paid out of 9,000. Remainder went to common stockholders. That's just the example of non-cumulative, meaning in arrears didn't matter. Cumulative, no dividends were paid. However, from 2012, they had how much in arrears? 9,000, and then currently they wanted to be paid 9,000. So that means they got both from 2012 and 2013, and then whatever was remaining went to common stockholders. So what does it mean to have preferred, participating preferred stock versus non-participating preferred stock?
Dividends will exceed the stated amount once common stockholders receive the dividend to preferred stated rates.
So what does this actually say?
That they can receive more than was stated on the, what's the agreement, what's their stockholder agreement?
Who determines the stated value?
The owner of the corporation.
Stated value?
Depending on the.
Board of directors, right? So if they're saying that to have participating preferred stock, that the dividend amount can exceed stated once what happens?
They receive the dividend.
Once who receives the dividend?
The stockholders, the,
Who?
preferred stockholders.
Not preferred, that's not what that
The
says.
common stockholders.
Common stockholders.
Meaning if there's something left over after the common stockholders are paid, they receive the rest.
Not the rest. What can they do? Think about it. What we're saying here is if I'm a preferred stockholder, a participating preferred stockholder, I already know I'm going to get first dibs on dividends, right? So that's a no-brainer. But then I also know whatever's left, generally you would do what with it? Pay who? Common stockholders. It's a chance that the amount left in retained earnings to pay the common stockholders is way above what we actually owe them. If we owe them 50,000 and we have a remainder of 70,000 left in retained earnings, there's still an amount of 20,000 left over, right? So what can I choose to do with that?
You can claim it as a common stockholder? Or the preferred state?
Preferred. Remember, they always get dividend. They get the preferential treatment, right? Meaning, what happens if I am a non-cumulative preferred stockholder? What that means is with my non-cumulative stock, I don't have rights to what's in what? In arrears. If you have a situation where it's participating stock and you paid your common, you paid me my initial dividends for the current year, I can probably elect for whatever is remaining for you to pay me in arrears. I can find some kind of way to get that kind of money. What about non-participating? And I'm gonna show you an example of it.
They cannot go over the stated amount.
Right, and notice they put in parentheses normal case. What that means is you get exactly what it says on the books, not a penny more for dividends as a preferred or common. Common never gets over anyway. But preferred, if you have non-participating stock That means that if it says that I'm only supposed to pay you $20,000 in dividends, that's exactly what you're gonna get. Not a penny more and not a penny less. And the only way you would get a penny less is if I didn't have enough in retained earnings to pay the full amount that's stated. Reasons for issuing preferred stock. We already talked about raising capital. They pay a higher price per share, right? Boost return earned by common stockholders through financial leverage. What does that mean? Common stockholders purchase stock to ultimately receive a dividend at some point, right? But we know that they don't always get dividends every year because it may be a situation where the retained earnings is held off for a few years to fund some capital projects, whatever the case may be. And they may not pay out dividends, but when they do pay out dividends, it may be a situation where preferred gets all of it. So they use that as leverage in the prior years to say, oh, we have X amount of dollars in our retained earnings. Because what does that do for them? When they go out there and they get financing to do these investment projects or whatever, it looks good to a bank for you to have amounts in your retained earnings because that means you can pay dividends at some point. To have a negative balance in your retained earnings would not look so favorable. To appeal to investors who may believe common stock is too risky or that expected return on common stock is too low. So obviously, if you pay a lower price for common stock, that may be a little risky for investors, right? They may say, I don't want to invest in your business because you have common shares that you're selling at $2 per share on the market is at $4. I feel like I'm going to lose money if I invest in your business. However, if you decide to, instead of wasting your time with the common shareholders, decide to just pick up preferred stock as a class, I'd be more willing to invest because at least I know there's going to be a significant return on those shares because the price is going to be not $2, it might be $12, it might be $22. Preferred stockholders pay a pretty penny just to be a stockholder in a corporation. So what's treasury stock? At this point in your book, I am on thank you, 524. What's treasury stock?
Incorporation, required shares, reacquired.
Reacquired. So they're basically repurchasing their own stock, right? And for what reason would they want to do this?
So that's one.
They give it to you up here. Buy other companies, acquire other companies. So I'm going to purchase more of my own shares so I can acquire other companies. Avoid a hostile takeover. How that works is the more treasury shares that you have of your own company, the better it is the situation for other companies in your same industry not to take over shares of your company by purchasing them all and having some kind of hostile takeover in the market. Reissue to employees as compensation. Has anybody in here worked somewhere where you have gotten stock options within the company that you've worked for? That's one of those situations. A lot of the bigger corporations like Walmart and Target and places like that, they do that. They will purchase their own stock so they can turn around and sell it to employees of the corporation because they know it'll continue to generate as long as the employee stays employed there and continues to contribute to it. And then support the market price. We talked about that previously. So purchasing treasury stock. They purchased 2,000 shares of their own stock for about $4 per share. They're just showing you that cash is being decreased by 8,000. Treasury stock is being increased by the 8,000. So what happens when they purchase their own stock and maybe they sell it, turn around and sell it? They purchased it for how much? $4, and they turned around and sold 100 shares of those for $4, which is the same price they purchased it for. They sold an additional 500 shares, but the price went up how much? $4 more, so it went up to $8. The treasury stock They made extra or excess of paid in capital 2,000 at that $8 per share. Paid in capital has now increased by $2,000. So what happens when they sell it below? They sold 400 shares, and instead of $4, instead of $8, they sold it for how much? $1.50. So they only received $600 in cash from it. The stock was actually worth how much?
I mean, 16.
$1,600. Paid in capital in excess of, or actually lost in that case, $1,000. Statement of retained earnings. So retained earnings is going to show you how much you can actually pay out in what? Dividends. So they're telling you that retained earnings is reported net income less any losses or dividends declared. Okay? Declare doesn't mean you paid them, right? Declare means what?
You already say that you owe it.
You owe it. It's a liability. So legal restriction. A lot of states are going to restrict what?
The
Amount of treasury stock purchase. So you can't repurchase like a lot. It's a restriction on the amount you can repurchase
Right.
into your own company.
Right. Normally the goal is to purchase them so other people don't take you over and purchase your shares and get majority of your company. The problem with that is you're restricted on the amount that you can do because remember, because you're purchasing your own stock, where does that money go?
Into your own company.
What's the account? Retained earnings. And it has to be paid out in dividends, right? So that's the restriction. We're not going to sit up and allow you to keep purchasing so much of your own stock, knowing that you're just going to turn around and put it in retained earnings. That amount is going to turn around and go out to stockholders. That's kind of like a monopoly, okay? And you don't want to do that. Contractual restriction, what does that mean? That's what I talked about earlier. You probably should not pay dividends under what?
Retained earnings.
Like if you have 5,000 in retained earnings and you choose to pay out dividends, you probably should not pay that whole 5,000. You probably should try to leave something in that account. Because who looks at it later?
Credits.
The bank, not creditors, but
Investors.
investors, right? Outside external parties. So this is just showing you retained earnings, appropriated retained earnings. What do we mean when we say appropriated? We just talked about it. They limit the amount of dividends that are being paid out. So while I would like to pay out $100,000 and I have maybe $150,000 in that retained earnings account, I'm going to limit it to maybe $80,000, and that's all I'm going to pay. So I'm going to appropriate only $80,000 of retained earnings. Okay, so that means he's not paying less, not paying more than the $80,000.
Is there a certain limitation on paying dividends to stockholders?
Depends on who.
If they're preferred or not. Or
Yes, it depends on if they're preferred or not, but it also depends on what the corporation, if they're going to appropriate a certain amount or if they're just going to pay whatever is owed. So that's going to be determined by the corporation, not necessarily determined by the stockholders. So what are stock options? This is the last area. Right. So, you know, some corporations out there, their employees have what we like to call stock options. Executives have stock options. So that just means that you're going to pay a fixed price for the class of stock over a certain amount of time, right? And it may go above that. The example they give you here, the purchase price or stock option was $30 per share. The market was actually how much? $75. So to have a fixed price at $30, you might be substantially losing money because the market is all the way up to $75, and you could probably go above $75. Why do they give employees options, stock options?
it's bonus incentives.
It's an incentive. And what kind of incentive would we say? They give you here an example of company performance. Meaning if you're on that management level, more than likely, you're gonna do all you can to meet those numbers so that you can have more options as far as stock is concerned. It also motivates management and other employees to stay with the company longer, to have some tenure. If you have stock options within a corporation, more than likely you're not trying to leave tomorrow because that's a huge investment on the employee's part.
So as a part-time employee, would you do like shared stock options?
If they offer it to you, not all companies offer it.
I like
I
that.
know places like Publix, they offer that to their employees.
Home Depot, I work at Home Depot.
Yeah, I've heard about them too.
So they have this share, and I've been just like shoving the paperwork aside. But now I understand.
Mhm,
what's
'cause
going
think about
on.
it.
I'll pick up their packet with them.
What if they
That's
offer?
not
Let's
bad.
just. That's a great example. Let's just say Home Depot offered you a stock option of $40 per share,
Mhm.
and you had the ability to purchase at least 10 shares. They're
Mhm.
worth how much right now at that $40? 400, right?
Mhm.
2 years from now, you're still with the company, and it continues to grow. And now, instead of them giving that fixed price of $40, $40, it has jumped up to about 90. So now it's worth how much for you now? 90 times 10 shares, right? $900. That's a good,
That's $5.
right? That's good for the company that you already work for. So you're getting paid a couple of different ways, right? You got stock options, so therefore you have some money in reserve, and you're also getting your regular paycheck if you continue to work, right? That's a good deal. So sometimes I would imagine all those wonderful people that work for Coca-Cola, absolutely. You know how the saying is, once you start working for Coke, you never leave. Every person I've ever known that works for Coca-Cola has been there literally for centuries.
Wow.
My cousin just started working for Coca-Cola.
And she probably won't ever leave. He or she probably won't ever leave. Literally, you get sucked in and you just stay there because of benefits like this. Stock options, obviously they pay great. Some jobs you get to travel. And it's Coca-Cola. Who would not want to, stay there? Same thing for like Turner Broadcasting, Pepsi, Home Depot, those types of companies. That's the kind of perk that a lot of employees are afforded. Okay, so now we need to do some problems. You need a break?
Get it up on.
It is very cold in here. Very cold.
Can you adjust the temp from here? Or
I've tried. I don't think that thing works. I think they have to adjust it on the outside. It was very cold in here last week as well. Okay, so let's take about 15 minutes and then come back. Oh, that's a
I said I didn't have a jacket with this time.
But no, I'm gonna really pick up the packet because I just been working there like 3 or 4 months.
Mhm.
But they start to offer, start to send stuff like that in the mail and things. I've just been kind of putting them aside, but I'm definitely.
All right, so chapter 13, we're gonna start off with quick study 13-2 on page 538. Quick study 13-2. So it says, prepare the journal entry to record Autumn's company issuance of 63,000 shares of no par value common stock, assuming A, the shares sell for $29 cash per share, and B, are exchanged for land valued at $1,827,000. So for the first journal entry, when we're selling the shares at $29 per cash share, what do we do?
Debit cash. For $1,827,000.
Debit cash for $1,827,000. And credit what?
No par value common stock.
No par value or common stock, no par. For the same amount, right? 1,827,000. Now, for number 2, where they have exchanged land for stock, the land was valued at 1,827,000 as well, exchanged that land. So what do we debit and what do we credit?
Debit land,
Debit land for how much?
1 million.
1,827,000. What do we credit?
Common stock.
Common stock. Is there any par involved? No par, par,
No par.
no par for the same amount. Good. Quick study 13-3. Prepare the journal entry to record Zendig Company's issuance of 75,000 shares of $5 par common stock, assuming the shares will sell for what?
$5 per share, $6.
So one instance is $5 per share. The second one is $6 per share. So for the first journal entry, we're going to debit what and credit what?
Debit cash,
Debit cash for what amount? $375,000. And credit what?
common stock,
Common stock, no
not par.
par, for $375,000. Now the way that we got that 375 is we did what?
Multiple 75,000 common stock.
75,000 shares times what price? $5. Okay, number 2,
$6 per share.
$6 per share. So what do we debit and what do we credit?
Cash and common stock.
Debit cash.
150,000.
What do we credit?
Common
Common stock. Is there anything else to credit? Yes, it is.
Capital.
What capital?
Oh, the gain.
Which is called, what's the
Paid in
account?
capital.
Paid in capital in excess of par.
value.
Yeah.
What amounts are we looking at here? How much total cash did we receive?
450.
450,000. What about common stock? How much was it worth?
375.
375,000.
375,000. And what was our paid in capital in excess of par? 75,000. Good.
So the paid in excess it goes whenever it's over or less.
The gain. It doesn't matter if it's a gain or a loss. You would always use paid in capital in excess of par for whatever that amount is.
But you said that hardly ever happens. I'm sorry.
No, it happens.
Oh, okay,
It happens.
it does happen. You know how it was saying the normal. Is
Oh,
you
you're
just
talking about the
get paid.
dividends, though.
Oh, okay, that's
Yeah, that's different from this, but
Oh, okay.
yeah, there's a lot of cases where it may be more so a gain than a loss, but losses do occur. This one with the what am I looking at? This here, there was it 75,000 shares times $6 this time. Okay. Good. Quick study 13-4. prepare the journal entry to record Javante Company's issuance of 36,000 shares of its common stock, assuming the shares have A, $2 par value, and sell for $18 cash per share. And then B, $2 stated value and sell for $18 cash per share. So the first one, we have to prepare a journal entry to record them issuing those 36,000 shares at $2.
Per value, then you
Not
credit.
not at $2. I'm sorry, at $18 per share. But their value was worth $2 per share.
So that would go into that in excess of
Uh-huh.
our account, correct?
Mm-hmm.
That's 16 times. 18.
Quick study 13-4. So what's the first journal entry? What do I debit and what do I credit? Give me the accounts first and then we'll deal with the numbers. What did you receive for all of this? Cash. So cash is debited. What do we credit?
Common stock and pay in capital and excess of par.
Okay. Because we know we're going to make a gain or a loss. And actually we can, what was the amount of shares that we issued?
36,000
So we issued 36,000 shares, $18. That's how much we sold them for. How much does that equal?
648,000.
648,000. And then they were worth 36,000 times the $2.
75,000.
They were worth 75,000.
It's 72,000.
72,000. Okay.
So you subtract that amount from what it was actually sold, and that amount goes in that capital and excess or whatever the loss, the gain on loss.
So ultimately, how much cash did you receive?
648.
648,000. Right. And you knew that the common stock was worth how much?
72,000.
72,000.
So your excess is 576,000.
So the excess paid in capital excess is 576,000. Good. Okay, so for B, this time around, it's not par value, it's stated value. How does that change anything? Does that change anything?
Well, where did you get the par value on the first one? Cause I don't see it how it said it on the first, on 13.3 where it says shares of $5 par value. This one just says of its common stock.
The par
Right.
value is inside the company.
Yeah, the par value is within the
Oh, okay,
actual.
okay, I got it.
So does the journal entry really change?
No.
It does a little bit. How does it change?
The capital, that paid in capital and excess of stated amount.
That's it. This is of par, right? And the second one is going to be of stated.
The common stock is gonna be stated.
Uh-huh. But the amounts stay the same, right? Common stock stated. That's important when you're doing books. Paid in capital. In excess. Stated. So 648,000 for cash, 72,000 for the actual common stock, and 576,000 for the paid in capital in excess of par. I mean, of stated. Good.
I just had iced coffee. My coffee cold.
Yeah, I'm gonna put mine on
I was like, I just put it down and I'm like, it's freezing.
I'm gonna put mine on ice.
We get that, we in the outburst, but I was like, weird.
It's sad. It's sad, you know.
He's
Well, technically, all summer we've been dealing with it being really hot. I don't think I've ever been in here that has been that, cold. And the only reason why I'm probably not as cold as you guys are is because I'm moving back and forth. But
You're in
yes,
front of that light on this screen.
I'm sorry. I wish I could share the share. Okay, let's do quick study 13-7, which is dealing with dividends, cash dividends. Prepare journal entries to record the following transactions for Emerson Corporation. July 15th, declared a cash dividend payable to common stockholders of $165,000. So, what is that journal entry for that?
Debit or,
Debit
retained
cash.
earnings.
Think about what we're doing here. This is the declaration. You know how we have those 3 dates? Declaration, date of record, and date of payment, right? This is the declaration. So the journal entry that you record for the declaration is going to be what?
Debit retained earnings.
Debit retained earnings.
Common dividend payable.
So retained earnings. And then credit common,
Dividend payable.
dividend payable.
Is it distributable or payable?
Well, we're not distributing it yet, right? This is the declaration. So the declaration means that we're just acknowledging that we have to pay it, that it's a liability. So it's just payable. But this is July 15th. And what's the amount that is being declared? 165,000. Okay, next it says August 15th. Date of record is August 15th for the cash dividend declared on July 15th. So now this is the date of record. What kind of journal entry do we do? Date of record,
A non-formal one.
formal. When you think about the 3 days, we talked about it. Date of declaration, we just did. Date of record, do you require a journal entry? No. So no journal entry required. And then the next one, August 31st, paid the dividend declared on July 15th. So what do we debit and what do we credit?
Debit common, dividend payable, and credit cash,
So debit, common,
dividend.
dividend payable, credit cash. How much?
165,000.
165. Okay. Good. Okay, exercise, and these are the ones I want you to circle, because these are the ones we're gonna go through. Exercise 13-2. Exercise 13-7. exercise, 13-11. Problem 13-3A. So starting with exercise 13-2. Rodriguez Corporation issues 19,000 shares of its common stock for $152,000 cash on February 20th. Prepare journal entries to record this event under each of the following separate situations. The first situation is the stock has a $2 par value. So the journal entry that we're recording is dealing with stock that is worth $2 par value per share. Mm-hmm. So first we need to figure out how much the share is worth.
$8 per share.
It's worth $8. Where did you see $8?
It's about $152,000 cash divided by the 19,000.
Oh, you've already calculated. So that's what I mean. That's what we need to figure out. No, that's not the part we need to figure out because they said they sold it at what price?
$2 per
$2.
card. So the first the first journal entry would be that,
Well, it's only one journal entry. I just want the calculations right now. How many shares are we talking about?
19,000.
19,000 times the 2.
19,000 times $2. How much?
That's 38,000.
38,000.
Stock has neither par nor stated value.
But the stock initially was worth how much?
152,000.
So you need to take that 152,000 and then do what?
Subtract it.
Subtract what?
38,000. Put that to excess.
Minus
Stated
38,000.
or
How much is it?
114,000.
Okay. So now, what's that journal entry?
Cash.
Debit to cash. Okay, credit,
Common stock.
common stock. And is there anything else?
Retain,
The capital
paid
and
in capital
excess.
and excess.
Paid in capital of excess of par. How much for cash?
152.
152,000. What about common stock? 38,000. And paid in capital?
114.
114. Good. Second one, the stock has neither par nor stated value. What happens when it has nor par nor stated value?
It's the same, right? We
What's the
put it
same?
down as the same, and we just don't put in excess, right? Or they don't get in excess, or
Explain that again. At this point, it's no par or stated value. So that means you gotta sell it for what?
What it's worth.
What it's worth. So, so
$8.
$8 a share. Well, they gave you the total amount, right?
Yeah.
So what do I debit? What do I credit?
Cash.
Debit cash,
And credit common stock.
common stock. What's the amount?
$52.
So for C or number 3, it says the stock has a $5 stated value. So what do we do now? What's the calculation? We know that we got 152,000, but we had how many shares?
19,000.
95, oh, well, we have the
19,000 times what per share?
five.
$5, which gave us how much?
95,000.
95,000. And you know you received 152,000 for it, right? So
95,
subtracting out that 95,000, you're left with what?
57,000
57,000.
access.
So what's the
Cash,
debit entry?
Debit, cash,
Okay?
credit, common stock, and credit, and paid in access to.
Paid in-
Stated. Is it stated?
It's stated.
Yes, stated value.
Stated. So cash is gonna be your 152,000. Common stock is gonna be how much?
95,000.
95,000. And paid in capital in excess of par or stated 57,000. Good. Moving right along. Exercise 13-7. Which is on page 540 and leads into 541. It says the stockholders' equity of TDX Company at the beginning of the day on February 5th is as follows. On February 5th, the directors declare a 20% stock dividend distributable on February 28th to the February 5th stockholders' record. The stock market's value is $40 per share on February 5th before the stock dividend. The stock market's value is $33.40 per share on February 28th. One, we need to prepare the entries to record both the dividend declaration and its distribution. The second thing we need to do is compute book value, change of book value in shares, and then compute total market value on investor shares in part 2. So the first thing with the journal entries to record the dividend declaration and the distribution. Remember, this is a stock dividend, not a cash dividend. So there's a couple of different computations that we need to do. So the first journal entry to record the declaration. Remember, there are 3 dates: declaration, date of record, date of payment. With the declaration, we're just determining what our liability will be as far as the dividend is concerned. So how are we going to calculate this? How many shares are being issued at this point? How many shares do we have?
60,000.
60,000. And what was the split? What was the dividend? The percent.
20%.
So that makes it how many shares that we're distributing?
12,000.
12,000 shares. So we know at least that we're distributing 12,000 shares. And now that we know the amount of shares, we're going to multiply that by what?
Dividend.
What's the price for them?
the $2, hold on.
Make sure you use the little grid, as well as the information that they gave you in the problem.
$40 per share.
Market price, right, $40 per share. So $40 times those 12,000 shares is gonna give us how much?
480,000.
480,000. What's the next step?
Determine the excess and rears.
Because what has happened? What changed? How much was it originally worth
$10.
per share? $10 per share, right? So shouldn't we do those 12,000 shares times that initial $10 that it was worth? And that gives us how much? 120,000. At this point, what do we want to do? Now that we know both of those amounts,
Subtract.
we want to subtract because we're trying to figure out how much is going to be paid in capital, right? In excess of par. So
360,000.
360,000 is paid in capital. So now we can successfully do our journal entry by debiting what?
Cash.
Retained
Retained
earnings.
earnings.
Remember, this is a stock dividend, right?
Declaration, yeah,
So retained earnings,
for the 480,000.
480,000. What other accounts? What do you do? What else do you do?
Credit,
Credit common stock what?
dividend payable. Do you credit?
Dividend payable or dividend what? Mary used it earlier. Used the word earlier. Distributable.
Okay, because it's saying that you can distribute it. It's not necessarily already distributed.
Okay, put it to you like this. When it's a cash dividend, payable. When it is a stock dividend, distributable. Okay? So, paid in capital in excess of par is the other account. What amounts do we allot to this?
360,000.
For which one?
The common stock is just 120,000.
Okay.
The paid in access is 360.
Paid in excess, 360,000. We balance, right?
Yes.
Okay, so that's the first journal entry. Second journal entry is to record what? Did we pay it?
The payment of it.
Or we didn't pay it? What did we do? We
Distributed it.
Yeah.
The distribution of it?
Yeah.
Or-
Distribution is all the same, right? So the for us to distribute the dividends, how much are we distributing?
The 480,000.
800 shares.
No, we're still on number one. Did they say that they were distributing the entire, well, yeah, that's right. They're distributing what we declared in the previous,
Declaration, right?
declaration. But remember, you can only distribute what the stock was what?
Word.
Worth. So what do we debit and what do we credit?
So we're only debiting that 120,000
What's the account?
to common stock dividend payable or distributed.
This is stock dividend, so we use distributable. Common stock dividend distributable.
Dividend.
Common stock dividend distributable. And what do we credit?
The cash.
You didn't, cash wasn't involved.
I meant the. I don't know that.
What are you distributing? Common stock, right?
Stock. Okay.
What amount? 120,000. What were the dates on these? What was that first date?
One is
February
February
fifth.
Fifth is the declaration that was distributed on the 28th.
2/28. Okay. So that's it for that. Number 2, part 2. One stockholder owned 800 shares on February 5th before the dividend. Compute the book value per share and total book value of the stockholder shares immediately before and after the stock dividend of February 5th. So we're looking at before and we're looking at after. We want to start with their equity before and then look at what actually was distributed at that point. So if I did 2 columns before and then after, and this is part 2. What was their equity before the dividend distribution?
1,575,000.
So stockholders' equity before was 1,575,000. Was it the same after?
After what?
After the
they divided.
distribution?
Oh, after they distributed. Shouldn't be, right? It was. It was.
Now how much did they issue?
20%.
Which we determined was what before?
12,000.
No, I mean 20%.
20%
The 1 million or the 60,000?
How much did they issue before the stock
60,000.
dividend? 60,000. Right? So we do 60,000 shares. How many did they issue after that? After the dividend?
12,000.
Plus what? It was 12,000 shares plus what?
800.
Not 800. We haven't gotten that far yet. You have to add what was already issued plus the dividend. So 12,000 plus what? 60,000, which is a total of what? 72,000 shares. And what do you think you're going to do with these shares in the beginning equity?
Subtract.
Subtract? Wouldn't it be more so divide? Did you issue them?
Oh, then they'll give you how much the shares are actually worth.
Right. So dividing, tell me these amounts.
The first one is 26.25.
So $26.25. What about after?
21.88.
Okay. Now that's basically the book value per share. Book value per share. And at this point, what are we interested in doing? Now that we have book value per share, we need to multiply that by
How
what?
much?
800.
The 800 shares.
That's where the
So see
800 comes in.
How much we issued the stockholder?
Right, so share, well, not what we issued, but basically what they owned, right? So owned shares, and you want to multiply that by, before the stock dividend, they owned 800, right? One owner or that person owned 800 shares. What's this amount?
21,000.
21,000. Now, how are you going to get the amount of shares owned after?
Multiply it times the amount.
Multiply what times what amount?
The amount that the stockholder owns, the 800 by the 2188.
Mm-mm. They didn't own that after. What did they own after the dividend split?
The 12,000. So then would you add that to the 800?
Mm-mm. They didn't own the 12,000 after that. Think about it for a minute, you guys. Just think.
Okay. They only own 20%. They can only get 20% of the 800, meaning like they can only get 20% of their value because they only declared that 20% of it was distributable
20%,
of 800.
not quite. I'm looking for something else. Just think for a quick second.
Oh, they do it times 40 because it was worth
40 was the per share market value price. That's not, yeah, that's not the percent. We're looking at what percent do we multiply. See if I can guide you guys back to the dividend area. Okay.
You only issue the par value.
We're looking for a percent, but you need to tell me what percent it is. It's not 20%.
Is it 50%?
Why do you say 50%?
Because that's what you said earlier when we were reading.
I said 50%. What did I say 50% for?
I forgot.
You were saying that when
Does it
you
have something to
have
do
a
with that over 25? Greater or equal to 25%?
It does. But I'm just waiting for you to tell me what percent it is.
So the percentage
25
of the
to
800.
25%.
It should be 25 because it's a large dividend.
Where are y'all getting 25%?
Cause you said it was
Greater
greater
than
than stock
or equal
dividend.
to
15%.
Why 15%?
So if you divided the 12,000 shares, it would just be divided by the 800 shares, which he owns. So he got 15% of the shares.
No, it's not 15%. What is it, folks? Think about it for just a second. Don't call out anything. Just think about what you have read and what you just learned today. And looking at the fact that it's a stock dividend that we declared, right? What are we looking for? Where did you get 54 from?
not 6%.
You guys know it, you're just not thinking,
That's the best way to say it.
you're not thinking critically about what you need to do. If we're trying to find, okay, we just did a split, right? Split means to do what?
Divide and have.
Not necessarily divide in half, but just to divide, right? So we only did a split for how much? What percent?
20%.
20%, which means how much left?
80%.
80%. Wouldn't it make sense in order to get up to what? What are you trying to get to? 100%. Wouldn't it be 100% plus what? The whole goal was to do 100%, but we did a split for 20% with 80% left. So once you get to 100%, you need to add in what? The initial stop, split. And maybe you need to write that down because if you see it on your homework and you have no idea what it is, that might hinder you. What I'm basically trying to say is, out of 100%, we did 20%, right? That's fact. However, once we get to this 100%, we need to add in that 20% to give us how much? How much?
120.
120. Who can explain to me why we do that? You read it. We talked about it. What's the whole purpose of dividends?
Oh, they assuming that the stated value is issuing an amount of excess, but they do it to make it look like it's, no, it's because of, like you said, we do it because of investors
And what do investors want?
they wanna see that you're able to pay your debt.
Which is called
With your arrears, your retained.
return. No,
Retained.
investors look for return on investment.
ROI.
So this is how this goes, and this is what I want you to write down because it's called a dividend yield. Okay. The market price was how much per share?
26.
$40. What was the price of the share?
So
The market price was $40. What was the other price? Yeah,
33.40.
33.40. Divide that and tell me what you get.
One point
1.19 what?
or 1.20 if you round up.
1.19 what?
Dollars.
No, 1.19. What's behind the 9?
Percent?
A 7,
7.
which means we round it up to 1.20, convert it to a percent, 120%. So we take that, right, and do our 800 shares times what? 120, which gives us how much?
And it's 960.
960. This is what goes here. That's after the stock dividend. So 960 shares times $21.88.
I remember that.
You would have, it probably would have taken you a little bit to read it, but you would have initially. What's this amount?
$21,004.
I got 21
I'm freezing. I'm sorry.
21.88 times 960 is 21,004.
But you gotta round up. If you round up,
Oh, I didn't round up.
Round up to what? It
I
would
just-
be 005 then if you round it up.
no. Rounding up to the nearest dollar?
What, the 2188?
No. $21.88 times 960 equals $21,004.08. If you round it up, then yeah.
But I didn't.
What they're trying to do is match the before and after.
Yeah.
So we would just assume 21,000.
If you didn't round up to 21.88, then it would be 21,000.
Right. But we just put 21.88. You know, it might help. Oh, because I didn't round up on the first one, right?
No, I did
What was that 21.88 before?
21.875.
Leave it at that. Should come out to 21,000. Okay. That's part 2. Part 3. Compute the total market value of the investor shares in part 2 as of February 5th and February 28th. What were the dates? February?
February 28th.
Okay. So what was the market value as of February 5th?
$40 per share.
And what about February 28th?
$33.40.
$33.40. And the shares, the amount of shares that were owned during those dates.
60,000. 20,000. I'm sorry, 12,000. 12,000 shares.
No. Read again. How many shares were owned?
800.
800 shares. So that gives us how much? 32,000. How many were owned as of February 28th?
960.
960. That gives us how much?
32,062.
$32,064. So it's the total market share amount. What other problems are there?
Really?
311.
13.
All right, exercise 13-11. The following information is available for Amos Company for the year ended December 31st, 2013. A, balance of retained earnings, December 31st, 2012, prior to discovery of error, $1,375,000. B, cash dividends declared and paid during 2013, $43,000. C, it neglected to record 2011 depreciation expense of $55,500, which is net of $4,500 in income taxes. And D, the company earned $126,000 in 2013 net income. So what they want us to do is prepare a 2013 statement of retained earnings for this company. And if we're preparing a statement of retained earnings, where do we start? Find that example in your book. How do we start a statement of retained earnings?
Put the, company's name on top,
Company's name, but what's the line? What's the first line?
retained earnings,
Retained earnings as of when?
February
Of what year?
2012.
Retained earnings as of 2012, end of 2012. What was the amount? Okay. Prior period adjustment. Was there any prior period adjustment? None?
What about that, you put, number C, is it, neglected to record 2011 depreciation expense?
Yeah, so that's the adjustment, right? Prior period adjustment, depreciation expense. What are we adjusting for? What's the amount?
55,500.
So 55,500. And once we subtract that out, that's gonna give us our retained earnings, our adjusted retained earnings, right? Of how much?
1,319,500.
1,319,500. Now, what else do we need to do? Because you had some other amounts.
Plus net income,
Plus net income. What was your net income amount? $126,000. And what else do you need to do?
less cash dividends declared,
Less dividends. How much were dividends? 43,000. So that means the retained earnings amount for 2013 is how much? $1,319,500 minus 126,000. I mean, plus 126,000 minus 43,000.
1,402,500.
1,402,500. Good. Okay. Last, problem 13-3A. So 30th, the end of Beijing Company's third quarter, the following stockholders' equity accounts are recorded. In the fourth quarter, the following entries related to its equity are recorded. The first thing they want us to do is explain the transactions underlying each journal entry. So all we need to do for part 1 is explain what actually happened. And then part 2, they want us to fill out this table that they have included at the bottom. So the first journal entry, October 2nd, retained earnings. They debit retained earnings and they credit common dividend payable. What do you think was going on in that transaction?
The declaration was made.
So problem 13-3A. And for journal entry on October 2nd, you said a declaration was made?
And October 25th, it was paid.
Wait a minute, hold on. So, declaration of what kind of dividend? How-
Dividend,
Cash dividend? How much was it?
60,000.
It was 60,000, but how much per share? You said it was 60,000 that was received, right? How many shares was that for? Was it not 30,000 shares?
The value at $12 per share, so 25,000 shares.
Well, what do you need to do to find out how many actual shares there were?
Yes, 260,000 divided by 12,
Uh-huh. Which gives you how many shares?
30,000.
So you're gonna take the amount of common stock shares, which was 360,000, and divide that by the $12 par value. That's gonna give you a total of 30,000. When they declared the dividend, 60,000 divided by 30,000 equals how much per dividend?
$2.
$2. So that's what we did in that first journal entry. Next journal entry, what do we do?
October 25th,
Uh-huh.
it was paid,
They paid that dividend, right? So that's what we want to say. Paid cash dividend. What about the next date?
October 31st, stock dividend was declared.
So they declared a stock dividend, and what percent did they declare it for? How do we know what we declared that stock dividend for? What was the total amount that you received? 75,000. So how are we gonna figure out the percentage in which we declared it? You had how many shares of stock?
60,000. 75.
75,000?
Yeah.
Is that how much you had? How many shares did you have?
A total?
60,000.
60,000. So, no. How much in shares did you have?
360,000.
That's how much they were worth. How many shares did you have?
30,000.
30,000. Now, you received the stock dividend was worth 75,000, correct? How are you gonna determine what was the stock, the percentage of distribution?
Would you divide that 75,000 into the 60,000?
Where are you getting 60,000? And why are you getting 60,000? Where are you getting that from? Forget the first journal entry.
Oh, okay.
We're talking about a stock dividend at this point, not cash. So they're telling you right there that they distributed how much in stock? How much was it worth that they distributed?
They distributed 36,000.
36,000. And you already know the price of the stock is how much par value?
So now,
$12. So when you take that 36,000 and divide it into $12, how many shares do you get?
300.
36,000 divided into that $12.
3,000.
3,000 shares. Now, 3,000 shares is gonna mean that we sold or we distributed how much percent of our 30,000?
10%.
10%. That's it. So we declared a 10% stock dividend, right? 10% stock dividend. We know we also declared 3,000 shares, right? You still with me? And how much did we make?
made 39,000.
We've made 39,000. So if you take that 75,000 and divide it by the 3,000 shares, what do you get? $25. So that means that $25 is how much? 25 per share, right? It was worth $12. You sold it for, or you distributed it for $25, which means you had a paid in a gain. Yeah. What about the next journal entry? What's happening in that one?
You give common stock for it.
So you distributed a dividend? What about the next one?
Change the title of the stock account to a new farm value.
So when you do stuff like that, what happens? Change the title of common stock account to reflect a new par value of $4, which means you did what with the stock?
So yeah, you decrease the value.
Split. That's it, Mr. Comey. You did a stock split. What about the next journal entry?
Close it out.
So you closed income summary to retained earnings. Okay, part two. What is part two asking us to do? They've given us that grid, right? And all those different dates that we did the journal entries for is what they give you in the grid. And the common stock was worth how much? On October 2nd. Because at this point, what you're doing is you're looking at the journal entry and putting things where they need to go based off of those journal entries. Come on, we got to do this for the win so we can get out of here. Okay. Common stock was worth how much on October 2nd?
$2.
No, what's the total?
30,000.
What? What does it say in the little green box? What was
Oh.
common stock?
Oh, sorry, 360,000.
360,000. What about on October 25th?
60,000.
October 25th didn't do anything to common stock.
Oh, okay.
So how much was it worth? October 25th. How much?
360,000.
360,000. What about October 31st?
360,000.
360. November 5th. Look at the journal entry. What happened on November 5th in the journal entry? Didn't you distribute a dividend? What else happened in that journal entry?
That's it.
No, didn't it just say there, it says common stock was affected, does it not? In the journal entry, what's
Is it-
credited?
Common stock,
Common stock. How many shares?
36,000.
So that means now common stock is worth what on November 5th?
Yes.
Come on, folks, use your brain.
324,000.
Where are you getting that from?
36,000 minus 160,
Why would you minus?
because the common stock is split for distribution.
You looking at the wrong thing. All we want to know is what was affected. Common stock was affected, was it not?
Yeah.
And it was credited, correct? So that means that it was increased. So 360,000 plus 36,000 equals what?
396,000.
What about December 1st?
Nothing.
Nothing. So that means common stock was worth how much?
396.
What about December 31st?
Same.
So on October 31st, when it says paid in capital in excess of par value common stock, you wouldn't, that's not affecting it?
It's not affecting the common stock account, no. It's affecting paid in capital in excess of par. That's a totally different account by itself.
Okay.
So what about common stock dividend distributable? October 2nd, did anything happen to that account? Common stock dividend distributable, did anything happen on October 2nd?
No,
No, so zero. October 25th, did anything happen to that account?
no,
Zero. October 31st,
36,000.
thank you. November 5th,
It balanced it out, I guess.
common stock dividend distributable,
36,000.
you paid it out, right?
Yeah, so it's back to zero.
Zero, that's it. December 1st,
Nothing.
zero. December 31st,
Nothing.
zero. Okay, paid in capital in excess of par, October 2nd, what was going on with it?
Nothing.
Yeah, it was something going on with it as of October 2nd, which was the beginning. What was the balance?
90,000.
90,000. What about October 25th? Did anything happen? No, so it's still what?
90,000.
90,000. What about October 31st?
Yeah, increase 39,000.
Decreased or increased?
Increase
Increased, how about by how much?
39,000.
39,000. So 39,000 plus 90,000?
129.
129. November 5th, 129. December 1st,
129.
129. December 31st,
Same.
129. Retained earnings. October 2nd, what was going on with retained earnings?
Yeah,
320,000.
And then what
No,
happened?
no.
Then increase by 60,000.
Increased or decreased?
Increase.
Decrease.
Decreased.
Okay.
So what's the amount in retained earnings as of October 2nd?
260,000.
260,000. What about October 25th?
Same,
Same. October 31st?
would you subtract that 75,000?
Yep.
So then you would have 195?
Mm,
Wait. 195,
185,000.
wait.
which one is it?
185.
Oh, yeah.
What about November 5th?
No, 185.
So it's 185,000 because nothing happened. December 1st
185,000.
and December 31st. All right. Add all these amounts, column by column.
The first one is 710,
Uh-huh.
the second one is 710.
Uh-huh. Third is what?
710.
Okay.
$710 for the fourth one. I guess it's 710 for all of them.
Nope.
That is what it came up to be, 710 for the last two also.
You know what? Retained earnings. Y'all told me 185 for December 31st. Why is that wrong?
Because they closed it, no. Because I-
Yeah, uh-huh, uh-huh.
They close the account for
They closed it out.
Yes.
So what happened to retained earnings?
0.
That last journal entry says they closed it to retained earnings, meaning to increase retained earnings
About 200.
by 210. So that amount for retained earnings is gonna be what?
Gonna add it.
185,000 plus 210 equals what?
395.
395,000. So that means that for December 31st, total equity was how much? 396,000 plus 129,000 plus 395,000.
920,000.
920,000.
Excuse me. Where do we get it in? This is done.
For retained earnings, they state
The 320.
that retained earnings started off at 320,000, and the journal entry for October 2nd shows that retained earnings decreased by 60,000. So you subtract 60,000 from 320,000. Okay, so that's all the problems. Remember again, next week you have no class, so I don't see you again until the 7th. But I will record a lecture for chapter 14 and email and put it on the front course page.
Don't forget
Okay.
to extend the homework.
Let me do that right